Good evening, friends, and welcome to this very important discussion on the topic of employee ESOPs. Uh, Being the July month, everyone is busy with the filing, and this is a very important topic for today's discussion about the taxability of employee ESOPs. We have with us our own member K. Prasanna, London Chartered Accountant, who is going to deal with taxability of employees issues in cross-border scenario, deductibility in the hands of the company, controversies, withholding tax obligations, and schedule FA disclosure. So there are a lot of questions which comes to our mind, especially while filing return of income as to the taxability of the cross-border ESOPs, and that also will be dealt with our speakers today. So friends, we are in for a very interesting session, and let's begin. And may I request Reda to introduce our speaker, okay, Prasanna. Thank you.
Thank you, Mayur sir. So, K. Prasanna is a chartered accountant and has an extensive experience of more than a decade in corporate and international tax and transfer pricing. And he has extensively advised clients on inbound and outbound structuring. He has also won the FIT fellowship scheme from Foundation for International Tax and has been a regular speaker at ICI, various study circles, and IFA, and has contributed articles on contemporary issues. So, this was the introduction asked to be said by Prasanna, but more than that, I think he has been and a person I look up to in terms of the knowledge that he has and the kind of grip that he has on a subject. And I think that would be very, very evident from today's lecture itself. So over to you, Prasanna.
Yeah. Thank you, Prerna. Thank you, Mayur, and thank you, Kush, for giving me this opportunity. So I will share my screen. So just to set the context, I will split the context into two parts. One, with regard to how ESOP has emanated in India as a practice of remunerating the employees. And the second part is on the taxation of ESOP in India, how it has transpired from 1999 until now. So if you look at any of the organizations, even especially startup or even the last 1 or 2 years, the newspapers we have seen, several startups or several multinational organizations has preferred ESOP as one of the important tool as a form of remunerating the employees. If you look at from an Indian context, at least from late 1990s onwards, there were some familiarity with regard to the ESOP, and people started using this as a tool to remunerate the employees. What are the features of the ESOP? If I were to quickly put it, it is an essential tool to attract talents, incentivize. Promoters also feel that the employee has contributed to the growth of the company. So therefore, it is essential to create some bit of wealth in the hands of the employees. Most importantly, use this idea as a retaining talent. So there is a lot of talent pool available, more especially if you look at from a technology industry point of view or even the startup point of view. This is one of the important form of a remuneration where there are twin benefits. One, it is a form of a deferred consideration. There is no immediate outflow in the hands of the companies. And second is that as and when the company grows, the employees who contributed to the development of the company also grows in terms of wealth because the share price gets increased based on several events. So as and when the ESOP are subscribed by the employees, they feel some sense of ownership with the company. So therefore, they show full potential in the company, and some sort of responsibility is being developed, and there is a interlinkage of the object and purpose between the company, promoter, and the employees. Usually, if you look at it, is given based on the predetermined price. A portion of ESOP has been allocated by the promoters for the purpose of incentivizing the employees. Say, for example, 10 to 15% is the percentage of overall paid up capital I have seen where promoters have allocated as part of wealth creation in the hands of employees in the form of a ESOP. And it comes with certain performance related conditions. Okay, the performance related conditions, as we progress, we will see it could be the independent employee performance, or it could be performance of the company by, let's say, for example, achieving a certain EBITDA or achieving certain milestone with regard to turnover, or a milestone. It could be in the context of funding. It could be series A funding, B funding, or C, as the case may be. This is more from a features of ESOP, why this has been used as a mechanism for incentivizing the employees. From a taxation point of view, if you look at, I have bifurcated this into four stages. One, Finance Act 1999. Before, you had this ruling of the Infosys Limited by the Supreme Court, where way back in 90s itself, Infosys has created a trust through which they have issued a warrant. So these warrants were entitled for shares of the Infosys. The assessing officer was trying to assess the gap between the market value and then the exercise price of the warrant as a taxable perquisite under 17(2) subclause 3. So what has happened before this? There was a circular 710 in 1995 where there was a clarification by the CBDT based on some of the representations made by the corporates as well as commissioner to assess the perquisite value. However, there is nothing on the law, but it is only based on the circular 7110 where they felt the difference between the market value and then the exercise price could be a benefit in the form of a perquisite. So therefore, it is assessable under 17(2) subclause 3. The Supreme Court said this: there is no specific provision under the Act to tax ESOP as a perquisite. And second point, what they have said is, whatever shares that are allocated as a part of the ESOP scheme designed by Infosys Limited has some conditions attached to it. The conditions is that shares could not be transferred for the period of 5 years. And if during the course of this 5 years, if the employee were to leave the organization, then they will not be entitled for any shares. So what they felt is this is particularly a notional benefit until the employee will not be able to see the future market value of the shares. So therefore, until the marketability, it is only a notional. Without a specific charge, you cannot tax it. Now, Finance Act 1999 had brought out 17 subsection 2 subclause 3A as a 2-point taxation levy. Until the date of exercise, it becomes perquisite, taxable as salary. And from there on, upon the sale of shares, the difference is taxable as capital gain. It is similar to the current mechanism we have here. Now, one point of important aspect is, at this point in time, stock appreciation rights were also considered as a ESOP in Finance Act 1999. Now, Finance Act 2001, based on the recommendations of Narayanamurthy and Mr. Verma committee, they've repealed the 2-point taxation levy and brought that as a single point of taxation only at the time of sale of shares. Now, after 4 years, we had this concept of fringe benefit tax, where the employer was taxable on the shares that are allotted to the employee as a part of ESOP. But there, the taxation is at the period of vesting. This is one important aspect which we will deal with it when it comes to deductibility, where department is trying to argue certain aspects from the fringe benefit circular from the perspective of deductibility. And then from 2009, when the fringe benefit tax was repealed, we went back to the old mechanism of 2-point taxation, where Up to the date of allotment, it is taxable as perquisite, and after allotment, once the shares are being sold, then that becomes a capital gain depending on the period of holding. So this twofold of taxation again is there, but if you look at, there is a slight difference between Finance Act 1999 and 2009. In 1999, a specific clause 17 subsection 2 subclause 3A was there, that got repealed, but in 2009 it was introduced in subclause 6, and we do have a specific valuation rules 3.8 and 3.9. Now, if one were to look at the life cycle of ESOP, it could be 5 stages. One, it could be a grant of options by the company. That is when the scheme was rolled out, and the scheme layout, the conditions or parameters by which the options are being issued to the employees. So depending on each category of employees, the scheme will say how many options a particular employee is entitled to, and what are all the conditions that has to be complied by the employee. Those conditions, in what period of time the employees have to comply, that becomes a vesting period. It is a process by which employee performs the condition which is set out in the plan. After performing those conditions, the performance conditions could be based on the employee's performance, or it could be based on company's performance. So it both converges. Once that is then it comes the period of vesting. After the period of vesting, I have a vested right wherein the employee can apply for the shares. So that application of shares is nothing but an exercise. I have a vested right. I have satisfied those conditions. Now I am going to the company, say, hey, look back. You have given me a grant of options with several related conditions. I have complied with those conditions. Now give me these shares, which is the exercise event. After exercise event, company does the allotment, which is regular allotment like any shares. And then comes the sale event, which is depending on whether the employee is willing to retain the asset or they want to monetize it by selling it. So these are the 5 critical events one has to look at. Now there is a twofold ways that a company is been implementing ESOP plan in real life. One, they set up a scheme. Based on that scheme, they will allot the shares directly to the company, directly to the employee. Once the vesting related conditions are satisfied, exercise has been done, exercise money has been paid, they will directly allot the shares. Then second is a situation where they set up a specific trust. The trust will hold the shares on behalf of the beneficiaries, which could be the employees. Upon the exercise of the shares, the trust will transfer the shares to the employees. So therefore, these are the twofold ways in which the stock options plans be implemented by the corporates. Now, if you look at, there are several forms of ESOP that are there, variants of ESOP, which could be, say, for example, employee stock option scheme. It is a situation where stock option is granted to an employee to receive a particular shares of a company at a future date at a predetermined price. Whatever we have discussed now will equally apply here. A variant is ESOP is called as an ESOS, where I do have a predetermined number of options that can be vested with the employee. The point of vesting has been decided, whether it could be vested over a period of 3 years or 4 years. Different types of vesting is there. It could be a uniform vesting. Say, for example, 1,000 shares is entitled by a employee. The employee's vesting period could be, say, for example, 25% over a period of 4 years. So here, 250 shares will be equally vesting in year 1, year 2, year 3, year 4, which is a uniform vesting. it could be a situation where back-end vesting. So instead of it is uniform over the period of 4 years, it could be 20% in year 1, 20% in year 2, 30% in year 3, 30% in year 4. Or it could be a cliff vesting where the entire 100% of the shares would vest only in the year 4. In year 1, year 2, year 3, you will not be entitled for anything. Another variant is restricted stock unit, where the employee is entitled for units, but that are subject to certain conditions. Similar to ESOP, it could be financial targets, employee performance, but the only difference between ESOS and other RSU, if you look at this, at the end of the vesting period, it could be either settled in cash or it could be either settled in units. Stock appreciation right is also similar thing. It could be settled in the form of an equity or it could be settled in the form of shares. It is based on the performance related conditions. At the time of exercising the options, what happens? Either it could be equity settled or cash settled. So in the initial, ghost units or notional units are issued to the employees. At the end of the vesting period, it could be either redeemed and settled in the form of cash or you'll be allotted shares. Phantom stock is nothing but whatever is the differential in the market value of shares from the date of grant till the date of exercise. Those differential incremental price has been settled in the form of a cash. Now there is a slight variation between ESOS and ESPS. The only point between these two is here, if you look at the shares are issued upfront, either directly or through a trust. But there could be a lock-in period for sale of shares. All the contributions towards exercise price will be recovered through a payroll deductions. If you look at that, that is option number 5 with option number 1. In option number 1, that is ESOS, the shares will be allotted after a vesting period, whereas here shares are allotted immediately, but it was subject to a lock-in period. So these are some of the variants. In addition to it, there are some other variants are there, say for example, ISO or NSO, which is there prevalent in US and UK, they have a different formation. So close to 10 to 15 different types of ESOPs that are there internationally. But if you look at from an Indian context, these are the 5 items which are primarily used by various companies. Now, taxation of perquisite in a brief manner. If you look at section 5, which determines the scope of a total income, there is a bifurcation between how the scope is for a non-resident and how the scope is for a resident. Scope for resident is slightly wider because even an income which is accrue or arise outside India is subject to taxation. There, the language in section 5 between a resident and non-resident is twofold. One, it also talks about accrual or arisal and a receipt. But whereas if you look at section 15, it talks about salary being due from an existing employer or a former employer when it comes to clause A. Clause B talks about salary that is paid but it is not due, possibly refers to advance salary. And subclause C talks about arrears of salary, which is taxable on payment basis. So clause A talks about due, clause B and C talks about payment. Now section 17, if you look at, it defines salary, which includes wages, annuity, pension, gratuity, fees or commission, advance of salary, payment received by an employee in respect of any period of leave not availed by him. And then subsection 2 of section 17 describes perquisites, which includes rent-free accommodation, concession in manner of rent, various other clauses. And in clause 6, it refers to value of any specified security or sweat equity shares allotted or transferred directly or indirectly by the employer or former employer, free of cost or at a concessional rate to the assessee. So therefore, similar to section 15, 1716 also refers to employer or a former employer. So the prima facie condition we need to look at is there has to be an employer and employee relationship. Without an employer-employee relationship, possibly the aspect of a salary may fail. Why employer-employment relationship is very important is because the charge is based on that. And second, one nuances which will come is what happens in a scenario. Say, for example, I'm an employee of an Indian subsidiary. The parent is in US. If the shares were to be allotted by parent company to the employee of a subsidiary, can I say there is an employer-employee relationship is there between the employee of a subsidiary and employee of a parent? One way of to look at this, the ESOP as a part of the group scheme has been developed. So therefore, what essentially the US entity does is it issues ESOP on behalf of the subsidiary. So therefore, whether a cross charge has been done from US to Indian entity, whether it is there as a part of the terms of agreement is irrelevant as long as it is as a part of the group policy. One way of look at this, effectively, this becomes an employer-employee relationship. One way of to look at is if you look at from a operational system wise, parent and subsidiary is one and the same. Only from a legal fiction, separate legal entity, these are regarded as a two entities. Even if you want that to look at the OECD commentary when it comes to ESOP, they look at parent and subsidiary as a group. So therefore, in those cases, even if for a subsidiary employee parent is issuing, possibly you may fall under the ambit of employer-employee relationship because in effect, on behalf of the subsidiary, the parent is issuing shares. There was one interesting case in the case of Emily Weber, where a third-party employee was deputed, and for those employee, the shares were ESOP were allotted. So there was the question of discussion before the court is whether this ESOP issued to a third-party employee who comes to the company on a deputation, whether it satisfies the requirement of salary or not. There the court has said that in case of a third-party employee, if I were to look at some of the parameters for discussing the employer-employee relationship, which is absent in this case. So therefore, in that case, the shares that were issued to the deputed employee of a third-party organization was taxable as income from other sources. So therefore, we have to be very, very careful when it comes to determining the employer-employee relationship. And one can very well look at para 8.14 of the OECD Model Convention to Article 15, where it lays down 7 to 8 conditions to determine who is a real employer or who is an economic employer. This particular para, we very well use it as a part of a secondment, where some of the factors that were considered as part of the employer-employee relationship is who directs the employee as a part of his work, who gives supervision and guidance with regard to the work, who puts the tools that are required for performance of a work, and who determines the leave-related obligations, performance-related obligations of that particular employee. Say, for example, tomorrow a salary has not been paid. From whom the right of enforcement of salary that the employee can claim. So these are some of the factors that were put forth to decide an employer-employee relationship. Now, one another important issue, like I said, 15 talks about salary from employer or a former employer. 17(2)(6) also refers to employer or former employer. What happens to a situation where if an employee were to issue ESOPs as a part of joining bonus? Because what it essentially covers is former employer or a current employer. But when it comes to a joining bonus, there is no possibly employer relationship unless I join the organization. But all the vesting related conditions and exercise allotment, everything has happened before even joining the date. So in that case, one possible interplay could come is whether 17(2) subclause 6 will apply, or 17(3) if you look at profits in lieu of salary. I'll just read out the relevant part. Profits in lieu of salary includes, I'm going to read only two clauses, clause 1 and clause 3. Clause 1 refers to amount of any compensation due or to be received by an employee from his employer or former employer, or in connection with termination of his employment or the modification of the terms and conditions. So therefore, it is not in connection with terms of an employment. So let's ignore this. Now look at the subclause 3. Any amount due to received, whether in lump sum or otherwise, by an assessee from any person before his joining any employment with that person or after cessation of his employment with that person. So if one were to look at, so in this case of joining bonus, where ESOPs are issued, whether should I look at 17(2)(6) or 17(3). 17(3), if you look at amount due, so there was an issue when it means amount due. Should it be only in the form of a monetary receipts, or it could be non-monetary as well? One has to look at the word amount used is only for a quantification. Unlike section the 50B before the Finance Act 2020 amendment, it never used the word any sum of money. Similar to our 56(2)(10), it never uses any sum of money. Whereas here it used only amount. So amount is only a quantification. So it could be even in the form of a ESOP. In Sampath Iyengar, the 13th edition commentary, where sweat equity, the view from the authors is sweat equity could be covered as a part of 17(3). Likewise, I presume that even for joining bonus, if there is no employer-employee relationship, that is current employer is not covered, anyway 17(3) will cover the future employer. But the only point of dispute is with regard to the valuation, which is there on the right-hand side. One important aspect is when it comes to eligible startup, the perquisite taxation has been deferred depending on 3 different events, which we'll deal with when it comes to withholding point of view. Now, if one were to look at the valuation, it is divided into 2 categories. One, listed equity shares and unlisted equity shares. Then we will keep aside the other securities. Now, between listed equity shares, it is twofold. Whether it is trading in the stock exchange frequently. If it is so, the average opening and closing price of the shares as on the date of exercise will be taken. If the company shares are traded in more than one stock exchange, then whichever stock exchange has a high volume of trading, then the average opening and closing price will be taken. In case of no trading, the answer is twofold. Say, for example, if the shares are listed on only one stock exchange, the closing price closest to the date of the exercise date is taken. In case the shares are listed on more than one stock exchange, then depending on the high volume in the past, the closest to the date, the closing price closest to the date to the exercise price will be taken. Now, the one slight difference here between the traded, significantly traded, say for example, bullet number 1 and 2 vis-a-vis bullet number 3. If you look at in bullet number 1 and 2, the average between opening and closing prices taken in case shares that are frequently traded. Whereas when the shares that are not frequently traded, it is only the closing price that has been taken for the purpose of valuation. And when it comes to unlisted equity, category 1 merchant banker has to determine the price of the ESOP. So therefore, this becomes a compliance cost when it comes to private limited companies, where for each and every time a ESOP has been allotted. So therefore, whenever we construct a plan, we have to be mindful of the fact that the period of vesting of various employees falls on a same period. Otherwise, what happens is, if let's say, for example, one ESOP is vesting on April, and another is vesting on August, and another is vesting on December, something is vesting on March. There are 4 different valuations required for the purpose of determining the market value as on the date of exercise. Other securities like unlisted equity, you need to have a category 1 merchant banker on the date of exercise date. One important point when it comes to ESOP is, if you look at the taxable event is only at the time of allotment, whereas the price used for determination is on the date of exercise. And there is a definition of specified securities. Option is also been defined. What happens in a case where an option has been forfeited, or when the options has been bought back, whether that falls under the ambit of 1726 or not, is a matter of some of the interesting issues. We will look at it. Specified securities, it asks you to go refer a SCRA definition, but only slight difference if you look at specified security means clause 2H of SCRA, and where the employee stock option has been granted under any plan or scheme. Therefore, that includes the securities offered under the plan. So therefore, the definition of specified securities is twofold. One, it goes back to section 2H of SCRA, or the securities that are offered under the ESOP plan or scheme. Now, when it comes to cross-border, there are various aspects that one has to be mindful of. Now, if you look at, I have bifurcated this into 6 segments, some of it with regard to the employees and some of it with regard to the employers. Employer-employee relationship, like we discussed, it is critical from a context of salary taxation, especially when it comes to the shares that are issued by the parent company for the employees of the subsidiary. Subsidiary is issuing a plan to the employees of parent, both from an inbound, outbound perspective. Period of services relevant for ESOP. Why period? Because if you look at the vesting, comes with the conditions. Now, which period is relevant for the purpose of determining the taxation? Something very, very critical, especially from a cross-border scenario, because the people movement from a cross-border scenario is very high. There could be a situation where an Indian employee, at the time of grant, he may be in India, but during the period of vesting, he may travel across multiple countries and render services in respective jurisdiction. Now, at the time of exercise, he may be in a different country, and at the time of sale of shares, he may be in a different jurisdiction. So therefore, various facets of the life cycle of ESOP may have different implications. Say for that matter, India is taxing ESOP at the time of allotment. Some other country may tax the ESOP at the time of grant. Some other country may tax the ESOP at the time of exercise. So therefore, this conundrum will have an important perspective from the period of services rendered, and then the place of performance of service and exercise of employment. Like I gave an example, India, an employee goes outbound. He renders services for 2 years in, let's say, for example, in Singapore. After 2 years, he returns back to India. which is the case study which we're going to deal with. So what is a period of performance and place of rendering of services also essential both from a Indian resident going abroad or a foreign person coming back to India. Why from a foreign person coming back to India it is more relevant is if you look at section 9 subsection 1 2, there the non-resident salary is deemed to accrue or arise in India if the services are rendered in India. So therefore, in those instances, if a part of a services has been rendered in India, to what extent India has a right of taxation? Can India impose tax on the entire amount of salary which includes ESOP, or is there any attribution principles that has to be considered for the purpose of taxation under 912? Likewise, an Indian resident goes abroad. His residential status may undergo a change because of explanation 1B to section 6. When you go out of India for the purpose of employment, which includes secondment, in that cases, there is a possibility that the residential status of an Indian person may undergo a change from resident to a non-resident. If the services were to be rendered outside India, then to what extent each of the country will have a right of taxation. Timing of taxation, like I said, India taxes it at the time of allotment. How the other country is taxing it is also important. Say, for example, if the other country is taxing at the time of grant itself. Now, as a source country, the taxation is earlier, whereas in resident country, the taxation is later point in time. Exercise. What happens during the period the employee discontinue is some of the interesting aspects which will come from the cross-border perspective. Likewise, characterization issue. Some country tax the ESOP on a salary basis. Say, for example, India. Israel taxing it at the time of sale. So they tax it as a capital gain. Because of this characterization mismatch, how do I allocate income between the two countries? And what happens to the foreign tax credit? Consequentially, either on account of timing mismatch, possibly one country may tax it earlier, another country may tax it at the later point in time. There could be a potential double taxation in 2 different years. How do I relieve me from the double taxation? And consequential effect on foreign tax credit. Second, characterization mismatch between 2 different countries. One country taxing it as a capital gain, another country is taxing it as a salary. So there is a disconnect between the characterization. How do the foreign tax credit work in this sort of a situation? Then comes the withholding tax obligations of the company. In case of a classic inbound or outbound, depending on the residential status as well as who is a employer. The withholding obligations under section 192 will have an important aspects because the consequence of non-withholding as a repercussion under section 201, where the employer will be treated as an assessee in default, and disallowance can possibly arise under 40A1, or even for that matter under 40A1A or 40A2. Now, another important aspect is I've issued an ESOP. There is a accounting standards which deals with the manner in which I have to account for ESOP under Ind AS. And we also have the guidance note from the Institute of Chartered Accountants of India, whereby they prescribe the manner in which ESOP has to be accounted. Whether these ESOPs could be allowed as a deduction, we do have some favorable precedents up to the level of various high courts, and we do have some negative precedents. Now the matter is pending before the Supreme Court. We will see what are the possible arguments that are there from the taxpayer side as well as from the revenue side, and how it is going to end up before the Supreme Court. And some of the important aspect is a transfer pricing aspect. In case of cross charges of ESOP, how does the transfer pricing mechanism works? especially in the context of cost plus companies. What happens when a cross charge happens, when the cross charge not happens. Likewise, deduction also, if you look at various companies follow different methodology when it comes to deduction. So therefore, in light of the special bench precedents, we will see where we stand as a part of deductibility and what is going to be unfolding before the Supreme Court. And just put together a simple case study. We are not going to do any sort of computations with regard to the ESOP part of it. No working of what is a tax rate, what could be the possible residential status, is there a dual resident, how do I resolve dual resident, or should I approach MAP in case I cannot relieve myself from a dual residency, or some of the possible conundrums could possibly come. But we are not going to work out each country's residential status and all, but from a bird's eye view perspective, let's look at what are all issues that could possibly come up and whatever issues that we have highlighted as part of this, how it manifests in the case study, and how do we resolve some of these hindrances that we have from a cross-border perspective, and where we need further clarity, either from the jurisprudence or more from the clarifications circular, and what could be the potential positions that we can unfold when we come to day-to-day interactions with the client as well as from taxpayers' perspective. Now, it is a situation where an Indian employee goes to Singapore. He's been granted 4,000 options, which will be vested over a period of 4 years in a straight line manner. Let's say, for example, 25% in year 1, 25% in year 2, 25% in year 3, 25% in year 4. He was deputed to Singapore for 2 years, and after his deputation, he resumed his employment in India. The issues for a deliberation is twofold. One, same scenario where Indian company is a holding company, Singapore is a wholly owned subsidiary, and we am flipping the structure. What happens if it's an inbound? Taxability of ESOP in the hands of Mr. S in India and Singapore, and entitlement to foreign tax credit, if any, in case of a dual taxation between India and Singapore. Deductibility of ESOP cost. Deduction for discount in case of any FMB between the date of allotment. This is a special bench conundrum which we will discuss at a later point in time. Alternative scenarios, if S is a tax resident of Singapore, he visits India. We are now looking at a situation of an inbound. One is an outbound and another is an inbound. What could possibly become? Like we discussed, I have bifurcated this into 2 buckets, and we do have some key jurisprudence from Indian context. When does the ESOP accrue to? So first, when it comes to the domestic law, when does an ESOP accrue to the employee, whether it is accrues over the period of vesting or at the time of exercise? We do have fair bit of understanding with regard to section 15 and 17 read together. The taxation arises only at the time of allotment. But as and when I perform the vesting related conditions, can I say the ESOP has been accrued as and when I perform the vesting condition? Say, for example, year 1, I've completed my vesting related conditions. So year 1, I'm entitled for it. Year 2, likewise, I perform the conditions. So 25% of 4,000 shares, 1,000 shares are accruing to me. One important aspect when it comes to the ESOP taxation is the period for which or the performance related to which this particular ESOP is entitled to. If you look at on the extreme right, we do have an allocation theory from the Delhi Tribunal in the case of Robert Arthur Curls, where during the course of vesting period, in case of a cross-border scenario, depending on the timing of performance, the ESOP cost are allocated. Like I said, 17.1 defines salaries, which includes perquisites. Now, section 912 talks about place of accrual of a salary. It creates a fiction that if you are rendering services in India, then to the extent salary is earned in India. So to what extent I have earned a salary in case of a resident or a non-resident? In case of a resident, it doesn't matter whether the salary earned in India or outside India. Anyway, I am taxable. But the moment I become a non-resident, to what extent then I will be entitled for? There, one has to read through some of the aspects of the scheme. There could be timing related conditions. ESOPs could be related to various performance related, the timing of service. Now, what is the timing of service? This ESOP is essentially is trying to address. Whether it is for past. If it is for past, then there is no question of vesting. Vesting has already happened. There is only a cooling off period which is there for exercise of shares. If it is for the past performance, there is the matter, entire vesting related conditions are done. So depending on the period for which the past performance, the location during which the services are rendered, that particular location will have a right to taxation. What happens if it has a mix of past versus future, or it is completely future? Now, in this case, if you look at the OECD guidance, the draft on employee stock option plan from a cross-border perspective, it gives some bit of light when it comes to the performance related conditions. What does it say is, where if it is for the past performance, how can I identify whether these ESOPs are issued for past performance? It could be based on the employee's performance for the back end of the years, or it could be based on the financial results of the company, or it could be based on the EBITDA that the company has already achieved. So these are some of the fact patterns one has to look at from the employee stock option plan to see what the ESOP is all about. Is it for past, or is it for future, or it is a combination of both? If it is for future, then it is easy. Say, for example, some of the plan does not specify anything. In that case, it is an unidentifiable plan where you only foresee, okay, it is only for the future. What happens if it is a combination of both past and present? The OECD guidance suggests if it is a mix of both past and present, you only look at it as a future performance related conditions. We do have one interesting jurisprudence from the Mumbai Tribunal in the case of V.S. Unnikrishnan, where they have considered past period before the date of grant for the purpose of allocation theory. So say, for example, in this case, Mr. S, past performance is also considered. Say, for example, the ESOP period is for over the period of 4 years. But if the past period of 2 years is also considered, then essentially I have to take 6 years for the purpose of allocation. One important aspect one has to be mindful of when it comes to this particular cases, we have an option which is vested over the period of 4 years. Now, each of this option, 25%, 25,000, 1,000 has to be separately allocated based on the period of performance in respective countries. Say, for example, with regard to the first options, assume for a moment the performance related condition is only for the period of 4 years. Now, with regard to the first two options, first 2 years, 1,000 and 1,000, he has performed his service only in Singapore. So therefore, Singapore has a right of taxation. Now, with regard to 3 and 4, part of the service are rendered in Singapore, part of the services are rendered in India. 2 years in, let's say, for example, year 3,000 options. 2 years he has rendered service in Singapore. Third year he has rendered service in India. So therefore, 2:1 ratio is the way in which you can allocate. Now, when it comes to year 4 shares, 2:2. 2 years in Singapore, 2 years in India. That is why it is important to know what is a period of performance with regard to each of these options. Now, there could be possible conundrum where you might be a resident in both the countries, which we will come to what is the OECD suggest when it comes to this. There could be a situation where there is a difference in financial year between the two countries. So therefore, do you have to broken down each of the financial year, or should you look at tiebreaker as a mechanism, or should you look at split residency as a mechanism? For the sake of example, we have presumed Singapore taxes it on a April to March basis. But if you really look at Singapore follows calendar year for individuals. So therefore, you may have to break it down between various financial years to assimilate what is the exact taxing rates of India vis-a-vis Singapore. Now, another important aspect, if you look at in this example, after 2 years, he comes back to India. And year 3, year 4 exercise happened in India. But with regard to year 3, 2 years of service were rendered from Singapore. When it comes to year 4,000 shares, 2 years of service is rendered in Singapore. Now, for a moment, if I have left Singapore, exercise have happened in the subsequent years. How do then Singapore tax it? OECD gives a guidance. What happens if a person has leave the source country before exercise, but exercise happened in some other years where he was not present in the source country? Now, if you look at the construct of Article 15.2, dependent personal services, all it talks about, you have to be present in that country for 183 days. So therefore, it calls for a physical presence. If this be the case, how do I then reconcile what happens in a scenario where I left the country of source, but the exercise of an event happens at a later point in time? OECD has given a suggestion that it doesn't matter as long as the ESOPs are issued in relation to the services rendered in the source country. Although the exercise in the year of exercise, you not being present in the source country, it doesn't matter. Still, source country has a right of taxation. So in this example, despite the person has left Singapore after year 2, year 3, year 4, exercise have happened in India, still Singapore will have a right of taxation with regard to period 3 and period 4 stock options, which is 1,000 and 1,000 with regard to 2:1 and 2:2 ratio. So therefore, it doesn't matter merely because you left the country and exercise have happened at a later point in time in some other country, doesn't mean that the country has to forgo its rights. This is one important point we have to be mindful of. It is equally flip side relevant for India. Say, for example, if the foreign employees were come to India during the course of a vesting period, he stayed in India, rendered services, but goes out of India and exercise the option in a different country, doesn't mean that India will not get right of taxation, because the situs or nexus is created with regard to the service rendered, service performed in a particular jurisdiction. Now, OECD guidance on certain mismatches. The mismatches which we have discussed is in the context of timing of taxation. What happens if source country taxes it at a particular point in time and the resident state taxing at a later point in time? So there could be, let's say in this example, Singapore taxes at the time of vesting. And India taxes it only at the time of allotment. So if there is any time gap between these two and the income falls in 2 different years, how do I then take a credit? Because as a resident country, I will tax the worldwide income. Even the incomes that are accrued in Singapore, I will tax it. Say, for example, Singapore has taxed this ESOP in year 1, whereas this year 1 income is taxable in India in year 2. Now, how do I then take the credit for taxes? This is a one situation where source countries taxes it earlier, resident country taxes it at a later point in time. Look at a scenario where vice versa. Resident country taxes it at earlier point in time. Source country taxes at a later point in time. So therefore, how do a resident country relieves double taxation is an important question. What OECD suggests when it comes to timing mismatch is that there should be some amendment in Article 23, which deals with elimination of double taxation, where there should be an unlimited carryover or carryback of foreign tax credits. So therefore, in case of unlimited carryover, in the first example, if the source country were to tax it earlier, resident country tax it at a later point in time, I can carry forward the foreign tax credit to the later years. And whenever there is a double taxation of income occur in a particular year, I will be entitled for credit. On a flip side, if a resident country taxes it at an earlier year, source country taxes it at a later point in time, the carryback of tax credit will permit me to utilize those credits that are available in the subsequent year to the earlier year, thereby double taxation is relieved. This is what, with regard to a timing difference, OECD suggests either unlimited carry forward or carry back, which will solve this purpose. Now, second possible mismatch could be on account of the characterization. Say, for example, I'll take India and Israel as an example. India taxes up to the date of allotment salary. Israel doesn't tax on exercise or on allotment. It is only at the sale of shares, they taxing it as a capital gain. Now, what happens up to the date of allotment? The difference between the market value on the date of exercise price minus the cost that the employee has paid is taxable as perquisite in India. In terms of numerical example, say for example, the exercise price is 10. The market value of shares is 110. 100 rupees is taxable as perquisite. Tomorrow this employee were to sell the shares and he is subject to taxation in Israel. He sold the shares for, let's say, 210. Now, 100 rupees is taxable as salary. 200 rupees, that is difference between the sale price, 210, and then the price that the employee has paid, is taxable as capital gain. Now, there is a characterization mismatch. So, how do the resident country will give him a credit? In that case, what OECD suggests is that an allocation of income between two different events. Say, for example, up to the exercise point, whatever income that is accrued to the shares should always be classified or characterized as an employment income. And anything that accrued after this particular event of exercise should be attributable to capital appreciation, because upon the allotment, the moment I exercise the shares and the shares are allotted, I am no longer employee with regard to that particular shares, whereas I am attaining the status of an investor. So therefore, any amount that accrues after a point in time will be regarded as a capital gain. So by this means, the characterization issues with regard to a particular point in time, that is the mismatch between salary and capital gain up to the date of exercise, is being relieved. There is no characterization mismatch. This is the suggestion given by the OECD. Potentially what happens is, another form of mismatch could be is that if you are a resident in various countries at a various point in time, say at the time of grant, you may be resident of India. At the time of vesting, you may be a resident of Singapore. At the year 3, you may go back to, let's say, for example, Israel. Year 5, you may come to India. So you could be regarded as a resident in multiple countries at a different point in time. In those situations, what the suggestions that were given is, go to competent authority to resolve the dispute if the dispute could not be addressed by the taxpayers, is some of the suggestions that the OECD has given. One interesting conundrum when it comes to the outbound ESOP, where if the Indian shares were issued to the overseas employees, assume for a moment they never rendered any services in India, Indian parent and subsidiary in USA. For the subsidiaries employees, Indian parent has issued ESOP. Now, if one were to look at the scope of total income for a non-resident for Section 5, read with 9, accrual is not in India because services are rendered outside in India. 912 says salary will be earned in India only if the services are rendered in India. No part of services are rendered in India. So therefore, the question of accrual or deemed accrual does not arise in this case. Now, when it comes to receipt is twofold. Let's forget about the deemed receipt because it is not relevant. The income which we are dealing with is only salary and not PF or other aspects which has been discussed in Section 7 or Section 198. Now, the receipt point of view, received in India, because the shares that are issued to the non-resident or of the Indian company, read with Vodafone ruling, the situs of these shares will be in India because the company is incorporated in India. By virtue of it, can someone says, no, all those services are rendered outside India. By virtue of receipt, can I tax it in India? Is one interesting aspect. In the context of the normal payment of salary, where the Hyderabad tribunal, in the case of Anil Bansali, said it is not taxable. We do have a Karnataka High Court decision in the case of Prahalad Vijendra Rao, followed by the Bangalore tribunal and the Chennai tribunal. Why this conundrum do come is, there was one circular which was issued by the CBDT in the case of settlement of money by issuance of shares, circular 382, where the CBDT has explained that if the overseas entity were to sell missionaries to India and then the Indian company issues shares to settle the obligations, where the interpretation of the CBDT is that the citation of shares of the Indian company is in India. So therefore, the receipt in India by which the particular sale transaction is taxable. So there is a question that can exercise allotment and sale date can be on the same day. It is possible. It is all how do you execute a transaction. So only trouble generally we foresee is when it comes to listed companies and all, there has to be some time gap between, because for allotment, there has to be a special resolution for which you need to have a adequate period for notices. But when it comes to unlisted companies, you have to be mindful of the time gap that is available in the articles of association. So if the time gap is 1 day, the notice is, if you can call for the meeting on the same day, then it is possible. Otherwise, practically, it is not possible. So it all depends on your articles of association when it comes to private limited companies. How to identify the prices of ESOP has been included in PUCs, and now shares are being sold. See, like I said, there is a valuation principles. Sub-rule 3.8 and 3.9 talks about the market value of it. In case of listed, stock exchange price has been used, but in case of unlisted, the valuation report from the merchant banker is being used for the purpose of determining the market value. I'll come to the disclosure part shortly in the subsequent slides. Now, so this circular 382 causes this conundrum. So in the case of Prahalad Vijayendra Rao, what the Karnataka High Court said it, the accrual of salary happens as and when you perform your work, while it is due at a later point in time on a particular day as per the terms of agreement, but the accrual has happened every day as and when you perform. Say, for example, you have a monthly salary which is payable, let's say, for example, 7th of next month. As and when I perform, I come to office, I perform an activity, my income is accruing, but it is due only on 7th of the next month. So therefore, the court went on to the premise to say that the moment salary is already accrued, then the later point of payment of salary is only a discharge of a debt. If that be the case, merely the discharge of debt has happened in India by virtue of making a payment to a bank account in India. That doesn't mean that receipt is in India. What essentially Section 5 requires is receipt of an income, not a receipt of a debt. So therefore, by virtue of that, they have held a receipt of a salary in an Indian bank account will not be subject to taxation. Applying the same principles to an ESOP standpoint, as and when I comply with the vesting related conditions, accrual has happened, but it is due or payment is discharged only on allotment. If that be the case, what I have received is only a discharge of a debt, merely because that being received in India, it is only a receipt of a debt, not a receipt of an income. This could be one possible argument can be made out. Article 15 deals with the dependent personal services from a treaty perspective. Generally, if you look at the primary rate of taxation is vested with the resident country. The secondary right is given to the source country based on the exercise of an employment. That is the place where you perform the services. Subarticle 2 of Article 15 lays down 3 conditions where the right of taxation is vested only with the resident country. Those could be a situation where if the employee is present in, let's say in this example, in Singapore, for the moment, let's forget about the 2 years he was in Singapore. If we stay in Singapore is less than 183 days, or the employer who pays the salary or who issues this ESOP is not a resident of Singapore, or the employer does not have a PE in Singapore, which bond the salary aspects. If these 3 parameters are satisfied, then the right of taxation is going to be only with the resident country, in this case, India. But applying this to the actual case, if you look at, he is being staying in Singapore for more than 183 days. First condition is not satisfied because these conditions has to be satisfied cumulatively. The moment I fail the 183 days, then Singapore has a right of taxation. Then as a resident country, I have to tax this income and relieve the taxpayer from a double taxation by allowing him a foreign tax credit. Foreign tax credit, which we have already discussed from a timing and characterization point of view. What is that OECD trying to address? Even if you look at Rule 128, also read with the proviso to Rule 128, it says is if an income is taxed in a particular year, that is the year in which you are entitled for foreign tax credit. So therefore, the wordings of the rule in such a way allows carry forward or carry back of a foreign tax credit. So therefore, I don't see a challenge when it comes to foreign tax credit. There is no need for a specific mechanism which should be there, should permit me like a TDS carry forward. There is no need for it because it is offered to the year in which the foreign tax credit is, the income is offered. So it can go back in time or go forward in time. And we do have a provision where the Form 67 could be filed at the end of the relevant assessment year. Sanjay Baveja is one interesting ruling which came recently in the context of the voluntary payment because of a specific event, where the Delhi High Court has asked the department to refund the taxes. The employer deducted taxes under Section 192, whereas the employee wanted to argue that this is not an payment which is obligated either statutory or a contractual obligations. It is because of a particular event where the company has divested a stake in particular investments. Because of which there is a loss in the value of the ESOP. To compensate that, the company has paid on a one-time basis voluntarily. So therefore, they've argued whatever the taxes that has been withheld, which is not subject to taxation. I do have a reservation when it comes to this, possibly be fall under the ambit of salary. Now, quickly coming on to the deduction related issues. I'll first take you through the arguments of the tax authorities. The main focus of arguments from the tax authorities is, see, whenever the ESOPs are issued, whether in case of an amount is collected from an employee as an exercise price, what essentially it happens is it increases the net worth. So therefore, this is nothing but a capital transaction. Anyway, as a part of ESOP, you are issuing the shares, thereby your share capital has been enhanced. So therefore, these are not related to a revenue expenditure. From a Section 37 point of view, this is clearly a capital expenditure. Another argument which they are trying to make is, generally the purpose of ESOP is promoters or the owners of the company wants to divest some stake to the employees. So thereby you create some wealth in the hands of an employee and you elevate them to some level of ownership status. Now, this status can be achieved in two different ways. One, the promoters can transfer the shares to the employees, or the company can issue shares, fresh shares to the employees. So in both the cases, the intent of the promoters have been achieved, which is to make the employees a owner. Circular 9 of 2007, which was in the context of FBT, where what it says is it differentiated between treasury shares and fresh issue of shares. Treasury shares is a situation where you fund the trust to buy shares from the market and then you allot it to the employee. So the moment you buy shares from the market, there is an expenditure that has been incurred by the company. So therefore, the difference between the amount of exercise price and then the price that the company has spent will be reduced for the purpose of FBT computation. So therefore, there is an expenditure incurred by the company and there is an exercise price. So the net amount is chargeable to FBT, whereas in case of fresh issue shares, no expenditure has been incurred. So likewise, when it comes to an issue, no expenditure has been incurred. So all it accounts for is a notional. And even that provision that they created is nothing but a notional entry without a proper measure. These are some of the arguments. And one another argument which they have put is whatever amount that you have foregone is nothing but a short recovery of a share premium. Ideally, the market price is, let's say, 110, and you have recovered is only 100. So the differential is nothing but the share premium which you choose to give away. So in that case, it is nothing but a loss of recovery of a share premium. And the ESOP trust, so what essentially happens is, if ESOP trust is purchasing this, they will obviously claim it as an expenditure. You look at the Mumbai tribunal ruling in the case of Mahindra and Mahindra, where the trust was subject to a capital gains taxation, where the amount spent by the trust in purchasing the shares were allowed as a deduction. And they've relied on the rulings of the Ranbaxy laboratories of the Delhi tribunal and VAP Industries from the Mumbai tribunal for the purpose to argue that these are all notional entries, and whatever the amount that was not recovered, that is the differential between the market value and then the exercise price, is nothing but a amount of share premium forgone by the company. Sorry, one another question before I move on. How to claim deduction in case of vesting on based on company's performance. So I'll come to the accounting part as well in a minute. So principles upheld in by a Karnataka High Court ruling. For claiming the business deduction, there need not to be an actual outlay of expenditure. Because Section 37, if you look at, it says the expenditure should not be covered under Section 30 to 36. And then it gives several other parameters. It should not be penal in nature. It should not be personal in nature. It should not be for in excess of CSR, all those aspects, penalty or fine. All those things come. Apart from that, there is a capital expenditure. Now, if you look at Woodward's governor ruling, it says expenditure also includes loss. Whatever the amount that the amount forgone by the company is nothing but a discount. So therefore, it should be allowed as a deduction. The purpose of ESOP is not to raise any capital. Rather, it wants to remunerate. This is nothing but a deferred remuneration offered by the company. Say otherwise, instead of issuing shares, if I were to pay them a cash incentive, I will anyway be entitled for a deduction. How does it make a difference if I pay in the form of shares? As per the accounting standards or the guidance note, I have been accounting for ESOPs. Say, for example, in the case study which we were discussing, 4,000 options were vested uniformly over the period of 4 years. So in the year 1, I will create a provision for 1,000 shares. Just a moment. Yeah, I will call you back now. For 1,000 shares. In the year 2, it is vested over a period of 2 years. So year 2 and year 1, I will account it. For year 3 shares, I will account it over a period of 3 years. For year 4, I will account it over a period of 4 years. This is what accounting standard says. You will assign a weight. Say, for example, year 1, you will assign a weight of 1. Year 2 shares, you will assign a weight of 2. Year 3 shares, you will assign a weight of 3. Year 4 shares, you will assign a weight of 4. This is how you will account it. Supreme Court also said this determination of exact quantum, that is the fair market value on the date of exercise, reduced by the exercise price. Exercise fair market value on the date of exercise date minus the amount that you paid as an exercise price will be a taxable value of perquisites. This can be determined at a later point in time. But whenever you do an account, that accounting, whether it has a fair estimate. If you look at ICDS 10, talks about reasonable estimate. So a reasonability of an estimation is what I am concerned about whenever I create a provision. ESOP cost is nothing but the on the date of grant, you foresee some of the conditions, how many employees will essentially exercise the options, and then you account for it. So this is nothing but a fair scientific methodology which was enshrined in the Supreme Court ruling in the case of rotor controls or Bharat Earth Movers, where Bharat Earth Movers dealt with leave encashment and rotor controls dealt with provision of warranty. Similar to it, the accounting standards under Ind AS or the guidance note of the ICAI prescribes the methodology where the ESOP are recognized over a period of vesting. So therefore, it is allowable. There is only one slight point or deviation between what special bench has held in the context of biocon. Whatever we have discussed is the principles level of it. From a computation standpoint, there is some differences between accounting and what the special bench has held. In the case of special bench, the ESOP were vested over a period of 4 years uniformly, 25, 25, 25, 25. So therefore, what they said is only in the year of vesting, you are entitled for expenditure. So therefore, say for example, if this 4,000 shares, the ESOP value is 10,000, I will be entitled for deduction 2,500 in year 1, 2,500 in year 2, 2,500 in year 3, and 2,500 in year 4 as per special bench. But how do I do an accounting for year 1? I will assign weightage of 1. For year 2 vesting, I will assign a weightage of 2. So I will account it for year 1 and year 2 in a 50-50 manner. Likewise, for year 3 shares, I will account it over the period of 3 years. For year 4, I will account it over the period of 4 years. So therefore, some differences could be there between what you account and what the special bench has said in case of a uniform accounting. There could be a slight or rather larger gap when it comes to a cliff vesting period where the entire options could be vested only in the year 4. If one were to look at the principles of the special bench, where it says only in the year of vesting, over the period of vesting, you are be entitled for deduction, then I will not be entitled for deduction in year 1, 2, 3, whereas only in year 4, you are entitled for deduction when it comes to cliff vesting. Likewise, in the case of a backend, but these are all pure temporary differences. But one point of contention we could always make is the special bench was ruling was discussed in the year in which you don't have much of the guidance. All you had is the guidance note of the ICA. Now you do have a specific standard which have a upper hold when it comes to the comparative with the guidance note. So this is one possible differences that could arise between guidance note and the special bench ruling. Another important aspect which was not before the Karnataka High Court is in the special bench ruling, if one were to discuss, there is a true-up adjustment which the special bench has allowed. The true-up adjustment is nothing but the fair market value as on the date of grant and the fair market value as on the date of exercise. So this differential also they allowed it as a deduction. But if one were to look at this particular difference were never accounted in the books of accounts. All you concerned about, be it under the guidance note or under the Ind AS, is only the fair market value on the date of grant. So based on that only accounting flows. The difference between fair market value on the date of grant and on the date of exercise were never accrued or accounted in the books of accounts. This was also allowed as a deduction because in that case, the fair market value as on the date of exercise is much more compared to the fair market value as on the date of grant. This was allowed as a deduction by the special bench. Unfortunately, that particular question was never a subject matter of discussion before the Karnataka High Court. Based on the special bench precedents, several companies have started making an additional claim before the assessment, the CIT appeals or the tribunal. Now we will get to know more about from the Supreme Court in short span of time. So this addresses the question on how to claim in case of vesting is based on company's performance. Whatever you account it as part of the accounting standard that prescribes. So another interesting question is outbound employees is issued shares of US parent while he's in India. After becoming a non-resident, he sells the shares. So the once you become a non-resident, whatever the income that accrues outside India, this is in the form of a capital gain, you will not be subject to taxation. But only one point you have to be mindful of is there any indirect transfer trigger as a part of when you sell the shares? If you look at explanation 7A to section 911, there a small shareholder exemption of 5% has been given. So one has to be mindful of the indirect transfer trigger when it comes to outbound employees, because US India treaty, the right of taxation is given to India when it comes to capital gain if there is a potential indirect transfer triggers. Now quickly on withholding related aspects and the disclosure. I know I'm overshooting my time by 5 to 10 minutes. Withholding obligations, if you look at 192, cast the obligations on the employer. 192 1A permits the employer to gross up the non-monetary portion of perquisites. You gross up the tax and then it is in a way what the employer subsumes the liability with regard to the perquisites. The only aspect here is the moment the taxes is being grossed up on ESOP, then that particular portion of tax is subject to taxation under 1724 as a obligations of the employee met by the employer. However, you do have a 10CC exemptions. 192 subsection 2 talks about a situation where if there is any simultaneous employment or a successive employment where the employees can choose the employer whom should deduct taxes. Say, for example, A and B are there simultaneously employed. In this example, I'm an employee of an Indian company, but the shares were issued by US. So I can go and tell the Indian employee that, okay, the shares have been issued by US. So please do consider that and then do a withholding. But if one were to look at the Supreme Court precedents in LLE, in the context of a secondment of an employee from overseas jurisdiction to India, where some portion of salary has been paid outside of India, where the Supreme Court said is nothing doing. India is the entity which is subject to withholding even with regard to the salaries that are paid outside India. If one were to apply that particular logic, then anyway India is under the obligation to consider the shares that are issued by the overseas entity under section 192. Otherwise, employees can file the declaration in Form 12B and make the Indian employer to consider the ESOP and do the withholding. Whether cross-charged by Indian entity or not is not a prerequisite as long as it is attributable to a employment, it is taxable. One can refer the jurisprudence in the case of Sumit Bhattacharya as well, where the cross-charge were never happened, but still the obligations were created under section 192. Contrastingly to before Supreme Court in LLE, we do have a AAR ruling in the case of Microsoft Corporation where the AAR said, no, in the case where shares are issued by the overseas entity, it is the overseas entity who is obligated to deduct taxation, but somehow that gets diluted in Supreme Court ruling in LLE, but there could be a potential conundrum with regard to this particular point. Anyway, practically, if you look at Indian entities do deduct taxation. Indian company issuing ESOP to its non-resident directors, MD, vesting and exercise will be done outside India. Can you please explain on the withholding obligations at the stage on which? See, when it comes to directors remuneration, we have to be very mindful of Article 15 and Article 16 interplay. If I were to say that there is, as per the terms of agreement, if there is no employer-employee relationship between the director and the Indian company, then Article 15 may not apply. Article 16 will apply. Article 16 does not go by place of exercise, whereas it goes by the place in which the company is incorporated. If the Indian company were to issue shares, then plausibly you will get covered under Article 16 and this particular income may get subject to taxation. But if one were to say there is an employer and employee relationship is there, exercise of services happens outside India and he being a non-resident, then by virtue of 912, deemed accrual may not get triggered here. So thereby ESOP may not becomes taxation even under the domestic law is one way of putting it. So if there is no taxation, then the consequential withholding may not arise under section 192. So we have to be very careful when it comes to directors, whether Article 15 will apply or Article 16 will apply. Depending on that, the position may undergo a change. So quickly on disclosures in Schedule FE. If you look at, there are 5 schedules that could possibly be relevant. Table A3, I feel it may not be relevant because this was amended as a part of FATCA CRS related regulation. So therefore, I don't see a situation where table A3 will applicable in case of a ESOP. In case of ESOPs, when it is granted or during the course of a vesting period, there is no need for a disclosures. But what happens in a scenario where vesting period is over and I'm entitled for exercise of a share? In that case, will I fall under the ambit of clause D is one, table D is one question. Do I have a beneficial interest? Conservatively, people do disclose in table D till such time it has been exercised. But however, there are some arguments that unless and until I actually exercise, there is no beneficial interest at all. Whatever I have is only a potential right, which I may use or I may not use. So therefore, conservatively, it could be disclosed in clause D. But the moment shares are allotted, I will go disclose it in table B. And after that, what happens is, at the time of allotment, a perquisite taxation will come. All I'm talking about, foreign company shares are issued to the Indian employee. Perquisite taxation needs to be disclosed in Schedule G, and any dividend income that I may have in future will also come under Schedule G. What happens if the foreign company were created a trust through which the ESOPs are allotted? Schedule F will become relevant because I may be a beneficiary to the trust through which I will get the entitlement of ESOP. The same grant vesting related aspects I may have to be mindful of. When it comes to stock appreciation right or restricted stock units, which is settled in the form of an equity. The moment ghost units or notional units are issued, I may have to disclose it under table D because it may potentially have a beneficial interest. Once the actual allotment happens, it's moved from table D to table B. And then similarly, perquisite taxation will be disclosed in Schedule G. Dividend income will also be included in Schedule G. Quickly to put the disclosures. So I'll take up a few of the questions. foreign entity RSU are given at zero cost and FMV on the date of vesting is considered for, can a view be taken that cost of investments will be zero for disclosure? Yeah, you have to say zero. It is disclosed as zero only. So any questions which I have left? 1 minute. One minute, I'm just checking. Deductibility if ESOP is to be vested on the EBITDA of a company. So whatever accounting which you have, so like I said, what are the plausible arguments that emanates from the biocon ruling is the actual quantifications may happen at a later stage, but I might have a fair estimation on if the accounting is based on a scientific basis. That is sufficient to argue, but still there is a conundrum between what you have accounted and what the special bench has held in the case of biocon. So far, that is not being challenged anywhere. All the department is challenging is you are not even entitled for deduction. So far, the cases or precedents I have seen, nowhere they have contesting on the differences between what has this special bench has held and what has been accounted for. One more question, I guess. See, when it comes to liabilities, if there is no requirement of a payment, then asset liability will be why there will be a liability at all. There is no liability for me, so therefore there is no need for disclosure there. Only foreign assets disclosure is required, not the liability, is my view. See, that is why I said if you look at A3, you may have to disclose it only in A3. Otherwise, there could be a duplication of income, like you said. Then there is a requirement of you have to reconcile if at all there is something has been picked up for assessment. See, the idea behind foreign one point of foreign assets and foreign income is just to see what is the level of assets do you have. Some bit of it may be used for the purpose of assessment to see what is the source of investments or what are all the subsequent income that you derived from the source. See, date of grant is what as per the scheme. Generally, the acceptance is only a formal confirmation. Date of grant, what it says is what is the grant date. So generally it is binding. So they will not usually ask for a confirmation. Yeah, Prerna, over to you.
Thank you so much, Prasanna. I think there's one more question, last one.
Which I have addressed.
Okay, this is also addressed, right? Okay.
Yeah.
With respect to the exchange rate, right?
Sorry, 1 minute.
Yeah.
I do agree there could be a mismatch. This was never thought through in the schedule. There will be a mismatch. I do agree with you.
Thank you so much, Prasanna, I think, for sparing your time. And I think this was really, really valuable. The intricacies that you covered in such a detailed manner with respect to perquisite taxation, capital gains. I think this is really insightful for the participants. So on behalf of IFA, I would now like to extend a hearty vote of thanks to you. Thank you so much, Prasanna.
Thank you. Thank you to IFA for giving me this opportunity.
Thank you. We can close the session, I think, Prabhakar.